Hello, Financial Accounting 1. I would like to review problem 15-10A, where they give us, you will find it on page 599, and they give us the trial balance in its entirety on page 601. They've given us the adjusting entries, which are here, and then we will do the adjusted trial balance, income statement, and balance sheet. We will then journalize the adjusting entries and closing entries, and then complete and make sure that we're in balance with the post-closing trial balance. So let's get started. There's a lot to do. So they tell us A and B, merchandise inventory as of December 31st is 28,900. We had a balance at the beginning of the month of 33,000. We need to remove that from our entry, from our account. So if we have a debit balance, we need to credit it by 33,000 and debit income summary. Next, we will have merchandise inventory of 28,900, which is what we want for the ending balance. And we will then credit income summary. Next, we have unused supplies of $1,350. We have a starting balance of $1,600, so that means we have to adjust for $250. So we're going to decrease by crediting the supplies account. And you will see we have to debit our supplies expense. Insurance expired of $300, so it means that we will decrease by crediting our insurance. And then insurance expense will be our debit. Depreciation expense for the year is $500. And then we need the depreciation expense equipment for $500. Wages earned but not paid is $480. So we need to account for that in wages payable. And we will expense it in wages expense. Unearned revenue of $1,000 we need to account for. So our unearned revenue account will now have a credit balance of $1,000. It started with a $5,000 credit balance. To decrease it, we need to debit $4,000, and we will also debit sales for $4,000. So now that we've put in all our adjusting entries, we need to complete the worksheet, which is just taking our numbers and pulling them across, making sure that now the balances are correct. If we have a debit balance and we have a credit adjustment, it decreases the adjustment. If we have a credit balance and a credit adjustment, it will increase our balance. And we will continue to do this all the way down. We made sure that our debits and credits tied out, and we're making sure that our debits and credits, again, equal. Now we will continue to create our balance sheets. We take our balance and we just pull them over. And remember, our balance sheet numbers are all of these. It is our cash, our accounts receivable, all our assets, our liabilities, and any owner's account. We will pull those numbers over to be part of our balance sheet. Next, we will take our income statement numbers, which, as you can see, is our revenue and our expenses. Our net difference, if it's a debit net difference, we have net income. Equal and opposite should be a net difference on the balance sheet of a credit. Now we know that we have a net income. We continue down, and each and every one of these entries, we now have to write the description. Just that way we put them into the appropriate accounts. So we have income summary, merchandise inventory, and so on. We're just taking these numbers from up above and journalizing them. Now we have to think again. We need to close out our accounts. So we need to close out our sales, our interest revenue, our purchases and sales and allowances. So we're going to take these numbers to create and offset it to our net income. These numbers we're going to look and get the totals from up above. Next, we're going to take all our expenses, take the total, and offset that entry to our income summary. We're then going to take what should be our net income, and let's confirm that it is, yep, 610. And we're going to take what is in our income summary and put it into our capital. This is W.P. Ellis's income, net income for the month. We now also have to close out our drawing account to our capital account. We also need to do a reversing entry because now we've paid the wages and it's no longer a payable and it is an expense. So $480, we're going to be reversing it out of these accounts. Now we're going to just take our balances after all our closing entries have been made and confirm that these balances, after these entries have been made, that these balances now tie out. But now we only have a balance sheet because we've put everything into our capital account. And you will see we do tie out. I hope this helps, and if you have any problems, please reach out to me.